I'm Mark Siegel, the EY America's corporate and ESG reporting thought leader. Thanks for joining me today for today's Think ESG dialogue. These are meant to provide insights from people influencing and knowledgeable about the sustainability reporting landscape. I'm pleased today to be speaking with an old friend, Dr. Christian Leuz. Regarding research on sustainability reporting, Christian has helped the Sustainability Accounting Standards Board, or SASB, and more recently, the International Financial Reporting Foundation, or IFRS Foundation, as they all think about what to do next. So let me more formally introduce Christian. Christian is the Joseph Sondheimer Professor of International Economics, Finance, and Accounting at the University of Chicago's Booth School of Business. He is a research associate at the National Bureau of Economic Research and a fellow at the European Corporate Governance Institute and Wharton's Financial Institution Center, among many others. He studies the role of disclosure and transparency in capital markets and other settings, the effects of regulation, international accounting, as well as corporate governance and corporate financing decisions. His work has been published in top accounting and finance journals. While Christian has traditionally focused his research in areas of accounting, reporting, auditing, and economics, one of his latest areas of focus has been on the impacts of hydraulic fracturing on water quality. So he's been diving more deeply into areas of ESG of late. I've known Christian for many years. I remember around 10 to 15 years ago, Christian did some work for the Financial Accounting Foundation and FASB, Financial Accounting Standards Board, as at the time there was considerations about whether or not the US should move to adopt international reporting requirements. During the financial crisis, Christian brought together various parties to discuss the role of accounting standard setters and prudential financial regulators with their different constituencies and stakeholders. So from personal experience, Christian routinely looks at how the theory plays out in the real world, and that's why he's so frequently looked to when there's an inflection point in corporate reporting. And I think it's safe to say that that's where we are right now with sustainability reporting. The EU, European Union, has a proposal to mandate sustainability reporting for issuers, which they have labeled the Corporate Reporting Sustainability Directive, or CSRD. In Canada, they recently proposed mandatory reporting on climate change risks and opportunities, which will look like a slightly modified version of the Task Force on Climate-Related Financial Disclosures, or the TCFD framework. And obviously, the SEC in the US, Securities and Exchange Commission, is considering whether to propose mandatory climate change disclosures and perhaps some specific human capital quantitative metrics too. So there is a lot going on in this space. So with all that as background, let's get into some questions for Christian. So Christian, what prompted you to look at environmental, social, and governance, ESG, and sustainability reporting in the first place?
First of all, Mark, good to be with you. Good to see you. It's always a pleasure to have the conversations and exchanges with you, and I've learned a lot over the years. So thanks for the opportunity. So as for the question, what prompted us to look into this space is, as you mentioned, and from our prior interactions when you were still on the FASB, a lot of the research that I traditionally done was sort of focused on disclosure, financial reporting, international reporting standards. And so then a couple of years ago, we were approached by the SASB, and maybe they had seen the report that you mentioned that I'd done for the FASB on international reporting, and said they were interested in better understanding what some of the potential effects of adopting sustainability reporting standards in the US would be. And they asked for an independent report that would kind of look at the literature, collate some of the potential effects based on our understanding of the literature and the expertise from studying the effects of standards more broadly. So they were really interested in saying, we're going to talk to some experts who understand how standards work, who've looked at the capital market effects, and we want to see how the sustainability reporting standards that they were putting out, what their potential effects might be. And then that project or that report morphed into a broader survey of the literature and of sustainability reporting, and that's the paper that's now published in the Review of Accounting Studies.
Okay, so you talked about that one. That's good tee up. What was the objective of that most recent research review that you and your colleagues have done on mandatory sustainability reporting? Have you presented the findings of that to any of the standard setters?
The objective was to collate and discuss what we can say based on academic literature and about the sort of potential effects of mandatory sustainability reporting. So the way we kind of set this up, we basically said, let's start from a hypothetical, which is we're going to adopt some sustainability reporting standards. We're going to make those mandatory, and then think through what this would mean in terms of the various, costs and benefits and potential effects that this might have. And one thing that was fascinating actually to see is we started out at the time with that hypothetical, and here we are where it is a distinct possibility that we're going to have mandatory reporting pretty soon. In terms of how we presented this work, as you might recall, we presented an early version to the SASB. The paper has changed a lot since then. And since then, we actually haven't presented it to the standard setters. We'd be delighted to present it to the FASB or also the SEC. We've talked to some of the people involved, but we would definitely be open to presenting it. Given the interest in the subject and how many ESG conferences there are, we've presented at a lot of conferences. There were a lot of events on ESG reporting, and there was one that we did joint with the IFRS Foundation in December last year that was, sort of on this topic and their efforts and in that space.
Good. I think that's really helpful. So in looking at all this, what do you think are the drivers for sustainability reporting? Are there, who's asking for sustainability reporting?
So I think the big undercurrent is obvious. It's of course climate change and the growing concern for the environment, as well as social issues. More specifically, I think I see two different objectives or drivers. So one driver is investor demand for sustainability information. So for one, investors are trying to get this information so that they can price the potential risks to the corporation or the company that they're trying to value. But they also need this information for their own sustainable finance products, for their portfolio goals, and so on. So that, I think that's sort of the investor side of things. The other driver is broad stakeholder demand, which goes beyond the investors, right? So this could be NGOs, environmental groups, society at large. And here, the hope is often that by forcing companies to provide information about their impacts on the environment or on society, companies will change their way they're operating or their impacts. And so traditionally, such impacts, we've addressed them through regulation. So say limiting pollution. But many of the ESG issues are global. And for many of the issues, it looks like traditional regulation is unlikely to come anytime soon. So for instance, right now, it's unclear whether we're going to be able to have a global carbon tax. So what the stakeholders, I think, are doing, they're pushing transparency regimes because A, they're often perceived to be somewhat more benign, and that's an issue we can come back to. And therefore, they're also often politically expedient. And that's sort of the second force. Now, if you think about these two forces, they will also imply two different objectives for potential reporting regime. One approach would be kind of more narrow, where you would be focusing on giving investors the information that they want. And the other approach would be broader and would be focused on facilitating or driving change when it comes to corporate impacts on the environment or on society. And in my mind, these are two very different things, that at least conceptually, but in the debate, they're often mixed. And in practice, they probably blend.
I think we should definitely hit on that. There's good stuff there. Let's talk a little bit more about the current state of sustainability reporting and where things sit as of today. There's clearly not one, just like in IFRS versus US GAAP, there's not one single global standard for ESG reporting today. But we're all still digesting news that just came out from the IFRS Foundation about launching a new sustainability board. But generally speaking, how would you characterize the ESG reporting ecosystem today? Are there regional differences?
There definitely are regional differences, and it is quite fragmented in that we have various organizations that have provided standards. So we have the SASB, we have the GRI, the IFRS Foundation entered the stage and moved very fast with their announcement now that there will be a sustainability standard setting board. Now, Europe in general, I think, has started earlier and is much further along than many other regions of the world. The EU, you mentioned them also briefly earlier, has been one of the strongest advocates for non-financial reporting. The EU has passed directives on this. So in that sense, they're much further than the US is, where we're really only starting to debate these issues right now. But it also has to be said that US investors and asset managers actually have played a pretty important role in terms of pushing ESG issues.
No, I think that makes sense. And I definitely agree that it's fragmented. It's often called alphabet soup today. Now let's get back to you mentioned GRI as one of the other standards that is just, if those, anybody's not familiar, that's Global Reporting Initiative. With all these different standard setters and all these different stakeholders, you mentioned two approaches earlier that parties can take around this, the narrow and the broad, and you sort of teased out that they might blend together, but they might also be different. Can you go into that a little bit? How would those two approaches, narrow and broad, how would they blend together, and how might they be different?
Sure. So let me start out with how they differ. The first approach, that what I would say is sort of more narrow approach, is focusing on the risks to the firm. So here we have kind of like an outside in perspective. How is the firm impacted by, say, climate change, right? And so the key question that we're now asking under that approach is whether these risks are financially material to the corporation, right? So that also means, however, and that's an important aspect to see, that if certain corporate actions are a negative externality from a society's point of view, meaning that they have a social cost, but not necessarily a cost to the firm, then they would not necessarily be captured or relevant under that approach. And the classic example for this would be, say the company emits CO2 and there is no carbon regime, then the emitting carbon dioxide is essentially free to the corporation. And so that means that that's not necessarily, carbon emissions would not be financially material to disclose. Now, the second approach is broader in that it focuses on the impacts of the firm on the environment and society, not just how the firm is impacted, but also how the firm affects the environment and society. So that's an inside out perspective. And here again, the goal is to drive change. So this approach would now capture or care about externalities because the carbon emissions obviously would have an impact on the environment. Now, where the two approaches blend is the securities regulators, the SEC has, or some of the commissioners have made statements to this effect, or the IFRS Foundation also had emphasized that their remit is to make sure investors have the information that they need. But we also have to recognize that nowadays a lot of investors have non-financial and green preferences too. So they don't just care about the financial risks to the corporation, but they might also care about the corporation's impact on the E and the S. And now when you say we're going to give investors what they want, that becomes a little bit more murky, because that may now entail also providing information about the impacts if investors do care about them. And then secondly, the consumers and the stakeholders often care about the impact on the environment and society. And because of that, we get stakeholder responses. So think about boycotts, right? Those boycotts can make an environmental issue very quickly material to the firm, even though the issue itself might actually be not that financially material.
So that was a great conversation. And I think that whole discussion about impact on the company, an outside in type of look versus an inside out or a broad perspective is extremely important, and one that is always of interest. And it sort of tees up the question around materiality. To me, is there anything you'd like to say? Because I think you really teased it out without using the word that much. But like when you hear things like single materiality or double materiality, some of the time, some of our clients get confused by those terms.
So single materiality is essentially our traditional materiality concept from financial accounting. It's whether the firm, its outlook, its cash flows are affected in a financially material way. And double materiality means just that we don't just care about the impacts on the firm, but we also care about the impacts on the environment and society. Hence, you have sort of this double materiality. And I think I've learned sort of two things from writing the paper about materiality. One is that materiality in the ESG space it's just a lot more complicated and nuanced than I would have thought initially. It's very difficult to say what would be financially material, once you kind of recognize that the stakeholder responses have to be taken into account. And the second aspect that I think makes materiality sort of complicated, and why I understand that people oftentimes can get confused here, is that materiality in the ESG space is often a lot more technical in nature. You need technical expertise to sort of to judge it. And that expertise goes beyond sort of traditional financial accounting.
Okay, perfect. And that's a good segue. I wanted to get into next, sort of the regulatory developments in the EU and the US. As you were doing this paper and this survey of academic literature, what were some of the thoughts around the pros and cons of mandating ESG disclosures and ESG reporting?
Yeah, you have 3 hours for this podcast?
No.
So as you would expect for a complicated topic like this, there is sort of obviously lots of potential benefits and costs. So answering in full would really take too long. But and I would also say that it's very difficult to say whether adopting a particular set of ESG standards would be net beneficial or not. And so that's something that we don't try to do in the paper. It's not meant to be a comprehensive cost benefit analysis. What we do, and that said, is that we show that academic research has a lot to say about what these potential costs and benefits could be, and that it can provide a lot of insights that are helpful to the regulators and the standard setters. So for instance, I think we can be pretty sure if ESG disclosures provide new and material information to investors, then we pretty much know from prior research that investors will respond to this information and that we will get the usual capital market consequences that we've studied for many years. So that means better information typically will improve the liquidity. It can lower the cost of capital for the firm. It should improve the capital allocation, right? Better information typically also means we get better oversight over the corporation. Another, now, we've talked about a couple of benefits. We've talked costs, for instance. One issue that's featured prominently in the literature is this notion of proprietary costs, that investors can use the information that the firm is providing for their own strategies and for the, in competing with the firm. That is particularly relevant, I think, in the ESG space, because we're often providing pretty granular disclosures about the business processes. Right. And so I think when we looked at this, our sense was a lot of the consequences are actually quite familiar from financial accounting. The one category that is, in my mind, a much bigger deal in the ESG space is this category of what we call real effects. And so by real effects, we mean changes in firm behavior that occur due to forcing the company to disclose something. So they come about because the firm anticipates the responses from the stakeholders. So that could be public pressure, benchmarking with their competitors, sort of comparing across firms. And they react because they expect these responses, or they see them, by adjusting their behavior. And so that obviously goes straight to that notion of driving change through disclosure that I mentioned earlier. And for the proponents of mandates, that is exactly what they want. This is what makes the disclosure regimes a useful tool, as they're hoping to change corporate impacts by exposing or revealing certain impacts. But the discussion highlights that how you think about these pros and cons depends a lot on your objectives. If your goal is to provide material information to investors, say, then the critical question is asking whether and why investors are currently not providing or not obtaining this financially material information. Right, the SEC regime is based on materiality, and it doesn't distinguish between whether something is financial or ESG. What matters is whether the information is material. So in that sense, if your goal is sort of narrowly focused on investors, it's not even clear we need a specific ESG disclosure mandate. There might be a compliance problem sort of broadly understood, and that could be, perhaps it's often unclear what is material and what isn't. And so standards could help with clarifying what in a specific situation for a specific issue is actually material. But in this case, I think the existing regime goes already a long way. If your goal, on the other hand, is that you want to drive change in certain areas that are important to you, environmental or social, then you will likely need to expand the disclosures in these areas And here, I think we can't simply rely on voluntary disclosures because that's going to have much weaker effects. But one thing that is super important is if you decide, that you want to drive change with, say, a disclosure regime, we also have to ask who gets to decide what change we're driving. And so then I think we need the same kind of democratic processes around this that we normally have for other regulation, be it taxes or, environmental regulations, say. So those are kind of the main things that we learned from our paper.
That's great. There's a lot there for anybody who's having to try to make those decisions about mandating or not mandating to chew on. The paper also talks a little bit about unintended consequences of requirements. And I think maybe you were touching on that a little bit with the real effects you were mentioning. But can you expand on this notion of unintended consequences at all?
Sure. I mean, we know from existing work that there are substantial real effects from disclosure mandates. And so, for instance, we have work showing that mandating greenhouse gas emissions or mandating the disclosure of these emissions in the US, so there's an EPA mandate, and also in the UK, they have more recently had a mandate for publicly listed companies, that those mandates have led to emissions reductions by companies on the order of 8 to 15%. That's quite significant, right? So in these cases, these effects are presumably what these mandates intended. But we still have to ask, first of all, even if we're getting some of these intended consequences, is the disclosure regime really the most effective way to induce that change, or they're better, or is it better than alternative ways of doing this and reducing emissions? In addition, and that's the part that we emphasize in the paper, there can be lots of unintended consequences or real effects from disclosure regimes as well. And we have several examples in the literature. Not sure we have the time to go into them, but in general, it's very hard to predict the real effects that a disclosure mandate will have, because disclosure regimes kind of work through a price mechanism. Right? The idea is you're imposing potentially a cost on the company through the stakeholder response, but that requires predicting how these stakeholders will respond to the information. And that is sort of what makes these regimes sometimes tricky in terms of predicting all the intended and unintended consequences. It's hard to know if the disclosure and the ensuing stakeholder response basically imposes the right costs or gives the right carrots on the right corporate actions. And that's an issue that we highlight in the paper, because I think there's a widespread belief that disclosure regimes somehow, because all they do is require disclosure, are somehow more benign than, say, the traditional regulation that limits behavior or imposes a tax or requires certain behavior. But what we emphasize, disclosure regimes can have unintended consequences too. They need careful analysis, just as traditional regulation does.
Right. So there's power, but there's also risk in a disclosure regime. Got it. So one of the questions that comes up frequently from my clients in the finance function of organizations is around internal controls for the ESG information. Much of it today is reported outside of the regulatory filings in the US. And so therefore there hasn't been a real focus on hugely amounts of internal controls. Did there anything in your survey and in your research yield any conclusions that regulators or companies should be aware of regarding controls?
I don't have a lot of insights on internal controls around ESG, but I think it relates sort of more broadly to something that is quite important and coming through in a lot of literature, which is assurance and enforcement. And we know from financial accounting that internal controls can play an important role in preventing accounting failures, as can assurance and as can enforcement. So the way I think about this is kind of like, it's almost like a three-legged stool. You have kind of the internal controls within the company, you have the insurance provided by, say, the auditors, and then you have enforcement coming through, say, the securities regulators. And all of them, I think, are very important to make sure that the implementation and the enforcement regime overall for the standards is solid. Because if I've learned one thing from sort of my extensive work over the years on regulation accounting standards, that is, standards alone do very little. We need to make sure that they're implemented and enforced well, and that's key to the success.
Great points. Thank you. Let's get into that a little bit and switch gears and talk a little bit about that comparison with financial reporting that you just mentioned. How would you compare and contrast the inflection point we seem to be at with ESG reporting with developments in financial reporting? What do you see as similar? What's different?
Yeah, I would say, especially at the international level, the current debate about ESG reporting reminds me very much about the debate we've had about international accounting standards and IFRS. This is sort of when, many years ago when we met and debated some of these issues around IFRS. People point, in the current debate that they want one set of standards that applies globally, that comparability, harmonization of reporting practices is very important. That was exactly the same that we had back then. And so if I look at the research on IFRS, I see a lot of parallels that apply from that episode to what we're currently experiencing. Now, there's one important difference, and that is that countries do not already have well-established reporting standards that are in place. And in that sense, we're not as entrenched than we were with the national, gaps that were in place before IAS and IFRS came along. So here, I think we have an opportunity to pull the existing expertise in sustainability reporting, to look at the existing standards that are being offered, what's out there, and then to come up with a set of standards that are broadly and globally applicable. And I think that's in part what the IFRS Foundation is trying to do, and that's something I like. Naturally, the countries can then still decide whether they want to go beyond those standards or whether they want to carve out certain parts, but I think it would avoid duplication if we followed that sort of a more global approach, and it would allow us to leapfrog that era of national standards that we saw with financial reporting.
Yeah, those are all good points. And as you were talking, it made me think about something that I've been sort of struggling with over the long term. And I'm not sure this was in your research at all, but I'll just ask you, do you have a personal view as to whether it one day would be better to have a combined standard setter for both financial and non-financial reporting? Because as you were talking about different national standard setters, I was thinking about also different financial versus non-financial standard setters. Any thoughts about that? I'm not sure that was covered in your research survey.
So I think the current argument for having two different standard setters or boards to tackle financial and ESG issues separately is basically one of expertise and speed, right? The FASB and the ISB have lots of important issues on their plates, and they wouldn't be able to quickly develop a set of standards. And I would also say that's an aspect we touch on in the study, that the standard setting process for ESG is likely to be quite different from the way the standard setting process for financial accounting standards has traditionally worked, in terms of back to the stakeholder involvement and stakeholder demand for those standards. And the expertise that's required in terms of setting these standards is probably also different. So from that perspective, at the current moment, having two standard setters probably makes sense. But it's also important to me to see that there are many connections between financial and non-financial accounting. Like the materiality discussion we had highlighted that. You could also see how the environmental issues will become more relevant to businesses and their operations. And if they're becoming part of the regular strategies, business strategies that firms have, say as countries adopt carbon regimes, then it becomes sort of natural for firms to talk about it, and then it might be covered in their MD&A or elsewhere in their normal disclosures, and then these things will blend, and then we can revisit the question whether it needs to be two or one standard setter.
Yeah, I think you're right. I think certainly at the moment, it definitely makes sense for all the reasons you mentioned to have separate ones, and I'll still reserve judgment about whether down the road it might make sense to have a corporate reporting standard setter, and I just don't know the answer to that off the top.
Yeah.
I just think about that. So listen, this has been a fantastic conversation. Let's talk a little bit about overall conclusions that you could draw from this. What do you think listeners should take away from today's session, if there are any key takeaways that you think are important for people to walk away with?
I think there's a few. First, I think we need to have a clearer sense for why we are discussing the an ESG reporting mandate, or why we want to set a mandate. What are the goals? That in turn defines the scope and also how we should think about the cost and benefits, right? To me, that seems to be step one. Secondly, I think many of the ESG issues are already financially material, and in principle, there are already to be discussed or covered in firms' financial reports, even under the current regime. I think that's something that I think a lot of people might not be aware, but this, again, the standards or the current SEC regime is simply about materiality. And here, I think standards could bring more clarity as to what is considered material and what should be reported in certain areas. I think a third kind of conclusion or insight is that while disclosure regimes promote more transparency, and we usually think of transparency as a good thing, they're not necessarily benign, meaning they can have unintended consequences, and they're not always the best tool to address an important policy issue. So the more expansive we make, say, sustainability reporting, the harder we'll have to think about these unintended consequences and real effects. And then the final thing that I would say, where I've sort of come around, is when it comes to, so, I mean, a lot of what I just said was basically saying we're going to need a lot of careful analysis. But for the carbon reporting mandates, I think the time has come. And the reason I say this is simply that for carbon or greenhouse gas emissions, we're essentially running out of time, and there are serious irreversibility concerns. And here, I also think that Paris and hopefully COP26 will provide more democratic legitimization for such a mandate. And so that's why I think for carbon or greenhouse gas, it would make sense to very seriously consider or even go for a mandate that applies to all companies. But for the other issues, for the rest, I would say take the time, carefully consider the cost and benefits. I think one final point here is that listeners should take away is that there's quite a bit of research that informs us about these costs and benefits that can be helpful.
That's great. Hopefully all the regulators will be looking closely at that research and making those decisions as they deliberate. What areas still require some more study?
I mean, there's many that come to mind, but I think the two that probably right now would be very important. One is, what are the reasons why companies don't seem to provide much of the information voluntarily that investors seem to demand in that space? So what's currently holding this back? Better understand some of those frictions. I think that, again, would be very useful input to the regulators in their deliberations. And we definitely need more research on these real effects, both in terms of how we can successfully use them as a tool, but also about the potential side effects that they might have.
Christian, thanks so much for taking the time to talk with me today. This was really great, really insightful. And I think it's pretty clear why the IFRS Foundation and the SASB and others wanted to hear from you as they're thinking about what to do next.
Thanks, Mark. Thanks for having me. It was a pleasure to be here.
Thanks for doing this. And thanks to all of you for viewing this installment of Think ESG Dialogues. I hope you found the discussion useful. For a broader perspective on ESG, please find our June 2021 webcast on the role of finance and the board in enhanced corporate reporting. In it, we hosted an audit committee chair, a corporate controller, and an expert from our SEC practice. Also in September, we hosted a webcast with 4 different investors to get the investor perspective on sustainability reporting and what they're looking for. So I encourage you to find that webcast too. Keep on the lookout for future conversations, and thanks again for joining us today. Thank you.